4 dividend growth companies, 5-year compound annual growth rate, increasing dividends year over year, safe payout ratios, high institutional ownership. I'm going to share them with you on today's Dapper Dividends. Let's get to it. Welcome back to Dapper Dividends. I am Russ. Thank you for being here and spending a little bit of time with me. I'm excited to share 4 companies that I've been looking at. I'm trying not to say stocks because I want to look at them as companies. They're not just pieces of paper or certificates. They are life, flesh, blood, people working inside of these companies to make them run. They are not automatons. I want to start saying that more going forward. So we're going to look at 4 companies that are paying solid dividends, have plenty of room to grow, safe payout ratios. And before I get to that, I want to thank you again for being here, listening to what I have to say. And please share the love with a like and subscribe. It would mean the world to me if at any point you find what I'm saying of value, or you can go ahead and do it now, like right now. I'll wait. Go ahead. Anyway, let's get to it. First on the list is ANTM, ticker symbol ANTM. They're the second largest health plan provider in the United States, serving 41 million members through commercial, Medicare, Medicaid, and federal employee plans. They have an 8.7% 5-year compound annual growth rate, which beats the healthcare sector, whose average is 6.6%. Now, the benefit of their large-scale health plan with their 41 million members is it helps them negotiate favorable pricing with provider networks. ANTM's licensure relationships are well regarded nationwide through Blue Cross Blue Shield. That's their competitive strength. Now, there is risk of legislative and regulatory changes to the managed healthcare landscape, but the healthcare industry as a whole has done really well since the inception of the ACA, the Affordable Care Act. Many people thought it was going to be bad for the healthcare industry. It has not. So this is something with the Biden administration that looks like it is going to be coming in. Really wouldn't be worried about, because they are intent on keeping the ACA intact, and the healthcare sector has actually done very well, as you see by the chart here. All right, ANTM, simply Wall Street does say they are undervalued with an excellent balance. ANTM on Simply Wall Street does say they are undervalued with excellent balance sheet, and they do pay a dividend. Last traded at $311.85. With dividends returned, their real pride here is in the last 5 years, where they have returned 150% compared to 75% of the industry and 89% of the market. You can see how those dividends coming back really do make a difference. This is a little bit much, but I understand it. The fair value they give is $614, but as you can see, what they use is an estimate of what the stock price is worth today based on the cash flows the company is expected to generate in the future. So that is basically the dividend discount model. They project what it is going to be in the future and then discount that back to today. They do have it as potentially 50% undervalued. Morningstar does give them a fair value estimate of $370. Their price to earnings is about in line with their 5-year average. They're forecasted to beat the industry, but not the market for earnings growth, and revenue growth is expected to just barely lag the industry and the overall broader market. They do have the savings rate is 14% growth, which is above the 2.2% bond savings rate. They have been at 2.5 to 3.5% profit margin, which is not very good, but it is trending up and going in the right direction, currently at 4.2%. Return on equity is 14%. They consider that low. I'm okay with it. I like to see a return on equity that is in the teens. Their financial health is fantastic. Plenty of assets that outweigh the short and long-term liabilities. My favorite part, the dividend. Now that dividend is small, it's only 1.24%, but if you are a dividend growth investor, this will continue to keep growing. They definitely do not compare well with the market. They are lower than the bottom 25% of the market and below the industry average. In 5 years, they're only forecasted to be at 1.3%. The dividends have been steadily rising. They are a dividend growth company. There is no problem maintaining that dividend going forward, which they do predict, though, in 2022 to be at 1.4% or $4.16 per share per year. If they chose to, they could grow a lot more than they currently are. They are at 19% payout ratio to shareholders, 13% to future payout shareholders. I wanted to give a good comparison with the other companies and show you that, yes, they are at 8.7% 5-year CAGR. That is ANTM. Next up is one of my favorites. This is one of my own. This is one that I love, and I do plan on buying more. CSCO, ticker symbol CSCO. CSCO Systems, they design and sell a broad range of technologies across networking, security, collaboration, applications, and the cloud. Many people wouldn't think this, but I think of them as being a part of the future in defense. They're providing frontline weapons. I don't think going forward that many of the threats are external as presented by a uniformed military, think like tanks, planes, submarines, things of that nature. I think cyber warfare is what the warfare of the future is, and it will be done by state sponsors that will, maybe hackers, people that can create and wreak havoc on cybersecurity systems, and CSCO is a big part of that atmosphere with what they do. CSCO has an 11.4% 5-year compound annual growth rate, which is just superstar status, and that beats the pants off the information technology sector, which is at 7.4%. So CSCO is in a highly competitive industry and sector. The technology space can rapidly produce winners and losers, and you can dethrone kings overnight. So that's why it is so impressive when companies like Apple and Microsoft can keep on top. So it's really good that CSCO has strong financials. They have over $30 billion of cash and investments on hand as of October 2020. Not worried about their balance sheet. CSCO Systems, I do own them. Flawless balance sheet, established dividend payer. Let's get into CSCO. Last traded at $41.17. It's been a little bit of rough sledding for CSCO. 5.5% negative returns in the last year. 23% return over the last 3 years, and 76% with dividend returns included over 5 years, but they are still underperforming the market. They give them a fair value of $66.48, currently at 38% undervalued. Morningstar gives them a fair value estimate of $48 and a 4-star rating. CFRA gives CSCO a $52 12-month price target and a 4-star buy rating. PE is at 16.6 compared to the communications average of 35.5. Their PE is really low, but just almost in line with the broader market. Only 4.6% forecasted earnings growth. This was by 8 analysts. Again, they're forecasted to underperform the industry and the market in both earnings and revenue, but you're still beating out the 2.2% savings rate on a low-risk government bond. They do predict the future return on equity to be 30.3%, which could be a little bit skewed if they are financing that with a lot of debt. Traditionally, they've had in the high teens profit margin, though in 18 and 19, they did hit that bit here where they dipped to negative profit margins, but they have popped back up to where they are today at 21% profit margin, although there has been slightly declining over the last few years. The past earnings growth has been way underperforming the industry and the market. But if you look at everything for the last 1 year earnings, everything has been down and they've pretty much been in line with the industry. Return on equity, 27%. Again, I like to see ROE in the teens to the high teens. Their short-term and long-term assets are really good, really stellar balance sheet that CSCO has. These can be skewed. I don't worry too much about the debt to equity ratio because there are companies that are strong like McDonald's And a lot of the financial companies will have low to no equity because they have a couple brains and some computers that they work with. As you can see, they did checkmark that CSCO earns more interest than it pays. So coverage of interest payments is not a concern. And that is one of the biggest things, the interest coverage, that I am worried about. But they just a fantastic balance sheet here. Their debt is well covered by the operating cash flow. No problems with their financial health. Again, the balance sheet just looks amazing. This is why I'm actually going to be buying more CSCO. They do pay a very nice starting yield of 3.51% on the dividend. Their yield of 3.5% versus the market. Top 25, 4.2%. Not quite there. Industry average 3.5%. So they're right there. The dividends per share just keep going up. They keep increasing them, and they don't expect that to change anytime soon. Current payout to shareholders, 58%. Very good. You really want to see something under 70% is kind of the benchmark that a lot of people use. The lower the better. They have plenty of room to keep growing that dividend. And in the future, they expect that to get even better. There's no reason that I can see that CSCO will not keep increasing that dividend. Next on the list, Lockheed Martin, ticker symbol LMT, is the world's largest defense security and intelligence firm and is also a sub-industry aerospace and defense important supplier to NASA and other non-defense government agencies. Lockheed's 5-year CAGR is at 9.9%, almost hitting the double digits, which is really doing well and outpacing the industrials sector at 7.4% CAGR on average. Over 95% of Lockheed's revenue is generated from government contracts, primarily with the U.S. Department of Defense, other U.S. agencies, and foreign governments. Given that 95% of Lockheed's revenue is from government Department of Defense contracts, other U.S. agencies, and foreign governments, if you remember when I talked about CSCO, I said that I believe they are part of the future security of warfare and the way that things are going to go in the cyberspace. I don't think that there's going to be as much of a demand for Lockheed Martin's products, but it is relatively safe. This is probably thinking way far ahead in the future, but it is something to keep in mind. Their advanced technology programs are high priority for the Department of Defense, but there is the risk in the near future that a Biden administration will have cuts to defense, and that'll trickle down into Lockheed Martin's revenue. But I don't think there's that much of a worry. It may be offset by their current high priority. Like I said, that may affect smaller companies, but Lockheed is the biggest and the baddest, and they have such a focus on high priority items that the Department of Defense does need. And one more thing to keep in mind is that historically, regardless of recessions, government defense spending usually has stayed the same or increased. This probably makes them very safe against cyclicality and down cycles. Lockheed Martin is an established dividend payer, and they have a proven track record. Last traded at $368.02. With dividend returns included, they still have had a rough year, as much of the market has. The 3-year better, 5-year even better, 84.2%, though not quite beating the market of 89.4%. But definitely much more favorable than the rest of the industrials industry. They do have a fair value of $417.68, putting them at about 11.9% undervalued. Morningstar has a fair value estimate of $433 and does give them a 4-star rating. You can see they are definitely under the 5-year price to earnings average ratio, so they are definitely undervalued right now, about 11% according to Morningstar. CFRA gives them a price target of $504 and has a 5-star strong buy rating on Lockheed Martin. Again, this PE shows them at 15.7, which is well below the industry and the market as a whole. Same old, Lockheed Martin keeps going up. They do forecast them to keep raising in the future. And I do wonder if they have taken into consideration a Biden administration and if there could be any potential defense spending cuts. Only 4.4% future growth and 4.0% future revenue growth, which is well below the industry and the market. And again, this could be because of the new environment of the administration that is probably going to be coming in. And again, though, they do beat the 2.2% low risk government bond rate. They predict the future return on equity to be 79.3% K Loco. A few years ago, profit margins were under 10%, and they did have that dip in 18 and 19. But as things are today, 10.3% profit margin is definitely respectable. I like to see at least a 10% profit margin. Their past earnings growth beating the industry and the market. Last 1 year earnings growth crushing the industry and the market, which were both negative. Return on equity, a ridiculous 132% compared to 10.2% in the industry. Again, I like to see that in the teens, but as Simply Wall Street rightfully points out, it is probably skewed due to their high levels of debt. They have enough assets to cover the short-term liabilities, but not enough to cover the long-term liabilities. But they are a defense contractor, so I don't think there's going to be any problems with them. Again, they have way more debt than equity, though it is starting to improve. But the big thing that I always like to look at is the interest payments on that debt are well covered by the earnings before interest and taxes, 14.3% coverage on those interest payments. They have $14.30 to cover every $1 of interest. And as they do point out here, the debt to equity ratio has reduced from 303% to 232% over the last 5 years. So it is trending in the right direction. Balance sheet looks really good. Only $11.6 billion of debt. My favorite part, the dividend, 2.83% is the current dividend yield. They are beating the bottom 25% of the market, and they are beating the industry average of 2.3%. They're forecasted to be at 3% in 3 years. Lockheed, like a plane, keeps increasing that dividend every year like clockwork, like a plane going up, 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 and away. They keep continuing to forecast that as going up. Super safe, only 41% of the current earnings is paid out as a dividend, and in the future that is continued to be forecasted to be in line with the current payout ratio. Ticker symbol TROW, the TROW price group, go into the financial sector for our last stock of the day. They operate one of the largest no-load mutual fund and life cycle fund complexes in the United States. And as of June 30th, 2020, they had more than $1.2 trillion of AUM, assets under management, and with an outstanding 11.6% 5-year compound annual growth rate, beating the financial sector at 7.5%. They look beautiful in my humble opinion. They do have a strong market share. They have an ability to attract new investment and relatively better than average investment performance. And there has been a shift to passive index funds and ETFs that are all the rage these days that everybody's investing in, like the VOO and the SPY. TROW has an ability, though, to introduce non-transparent ETFs as a long-term positive for their firm from a strategic and competitive standpoint. Their most distinctive feature of the ETFs that are non-transparent, that they also call ANTs, is that they prevent the market from forcing the investment firm to tip their hand as to what they're investing in. There are good and bad to this, and maybe we'll cover it on another video, but it is something that is unique that allows them to have a little bit of a stronger market share. TROW price group, flawless balance sheet, undervalued, and pays a dividend. Last trading at $137.46. Check out the returns. 17%, beating the industry, not quite beating the market, with dividends returned 52% over 3 years and 108% return with dividends over the last 5 years, crushes the industry and the market as a whole. They have a fair value of $187.64, currently making them about 26.7% undervalued. Morningstar has a $125 fair value estimate, 2-star rating only. Price to earnings is just about in line with its 5-year average, slightly undervalued. CFRA has a $150 12-month target and they do give them a 4-star buy rating. PE is at 15.3, which is beneath the industry and beneath the market. Earnings and revenue were going up, then a little bit flat, but they do predict them to keep increasing over the next couple of years. Forecasted annual earnings 7.4% and 7.5% for the revenue. Earnings will underperform the industry and the market. Their forecasted annual revenue growth 7.5% will be predicted to beat the industry but underperform the market as a whole. Again, still beating that 2.2% savings rate, though. Most of these will. Future return on equity forecasted to be 30.9%. Annual earnings growth, 13.4%. That is respectable. Margins in the 30 percentile range, currently at 34.9% profit margin. That is very, very solid. Past 5 years, the company has had 13%, which has been beneath the industry, but outpacing the market. And the last 1 year, though, 9.8% compared to the negative market and only 5% from the industry. Return on equity, this is what you love to see, 25%. They have a very high return on equity. Superstar financial health. Look at the balance sheet. This is just beautiful. Their short-term assets crush their liabilities, and the long-term, get out of here. Look at that. That is absurd. $221 million of liabilities to $7 billion of assets. This is fantastic. Fantabulous. Get a good glimpse of this. You don't see this much. Debt, zero. Zero debt to equity ratio and climbing, getting further and further. That is just something that's very fun to see. TROW has not had any debt for the past 5 years, and they have no debt, therefore they have no interest payments, so it's not a concern. This is a fun balance sheet. There's no red. Let's move on. This is beautiful. Dividend, 2.62%. It would be nice if that could be over 3%. The ex-dividend date is the 14th. If you don't know what that is, you have to be in by the 13th in order to qualify for the dividends on December 30th. They are right smack dab in the middle, beating the market bottom, but not quite the top 25. They're beating the industry average, and in forecasted 3 years, they're expected to be 2.7%. Dividends keep raising and going up. I don't see any reason why this would stop or go flat in the future. They will just keep on increasing that dividend. Very low current payout. Only 38% of their earnings is paid out as a dividend, and in the future, they expect that to be in line and flat. There is no reason they will not be able to keep continuing that dividend. It looks very, very solid. Hi. So expertise does come from the community, from you, the members. Thank you for being here. Leave a comment below. Let me know what you think about any of these companies. If you would invest in any, or if you do, what's your opinion? Let me hear it. I want to know. I want to know what you're thinking. Duran is a fantastic group from my childhood. Follow me on Twitter at RustyRam78. I have a podcast I do twice a week. It's just this little thing where I share some thoughts. You can find that on all your major podcatchers under the Dapper Dividends name, which I also have a website, dapperdividends.com. And please give me a like and subscribe. I really could use the support on my march to 1,000 and beyond subscribers. And now the friendly disclaimer, as my main man Ian Lopik says, I am not a licensed financial investment advisor, and this is not financial advice. I am your humble host and just sharing my opinions. I am a welder, and a very good welder at that, who is a passionate dividend growth investor, doing my own due diligence and encouraging you to do your own due diligence and speak with a fiduciary licensed financial investment advisor. And I talked about NIO, ticker symbol NIO, in my last Lunchbox Stocks. I explained what their ADR fee is, and I love you. I thank you for being here. I know you can be a great investor, and it all starts with habits. Without habits, there is no money. The money is not as important as the habit. You have to get started. And good habits become just as hard to break as bad habits. I know I've been on both sides, and the good habits are so much better for your financial future and your financial future health. Take care. I'll talk to you next week.